biggest mistake I think investors in companies like Aduro make is not what you would expect. It's not finding these needle in a haystack companies that will do really well. It's also not convincing yourself to put a large portion of your portfolio on those companies, so when they make it big, your portfolio reflects that. No, I really think it's something else that's not really obvious, but by the end of the video, I think you will agree with me that this is the largest mistake that all investors, and especially investors in small promising companies like Aduro, will really have to prevent to be successful. So the company we're talking about is Aduro Clean Technologies, ticker symbol ADUR on the Nasdaq, and I am an investor in the company, so I am biased, but other than that, no one paid me to do this content. So in this video, we'll be talking about quite a lot of different other companies and topics that might not directly make sense of how they connect to Aduro, but if you stay until the end, I think you will understand how it fits in the bigger picture and how it makes sense why I mentioned them and how they connect to Aduro. So the first company that we're going to look at it was really a monster in the making, and the company is Monster Beverage, renamed after their most popular product, Monster Energy Drink. It used to be called Hanson Natural. And they were around for quite a bit before then, but by 2000, they had a list of products that was almost absurd. They had tons of different packaging sizes, tons of different products. They weren't really all in energy. They had like juices and different packaging, different stuff. And it wasn't really clear what the company was really about or where the growth was supposed to come from. By 2001, it almost looked like a failed company. They had negative earnings growth. They were slowly looked like fizzling out. They had earnings of 30 cents per share and, trading at a 12 PE because the company, was not really looking like a winner. So, investors discounted that by giving them a lower valuation. By 2002, they really started their turnaround by really focusing down and experimenting and trying to, focus the company on less products, and that were actually successful. They didn't have any internal manufacturing, so they outsourced that, and this way, they could test out lots of different products with different packaging because they didn't have to do the manufacturing, so they could really dial down what product they wanted to make. By 2004, the quarterly earnings growth was really rapidly increasing, so up to like 220% quarterly earnings growth, which was amazing, obviously, and investors rewarded that, of course, because they saw rapidly rising earnings, which investors rewarded by rising valuations. So by 2006, the split adjusted earnings were around $8 a share with a PE of 50, which is a really big increase in both earnings and price to earnings multiple. So the earnings went up around, these are all very approximate numbers, by the way, so just to make a point. The earnings went up about 28 times and the multiple went up about 4 times, which means about 100 bagger in 5 years. And for anyone who bought this, let's say, turnaround story, really understood what they were doing, made 100 bagger in just 5 years with, paying 12 price to earnings multiple, so pretty low valuation, not a lot of risk in that case, and investors made a lot of money. And if you look from 2006 until currently 2026, they went up another 20x. So if you bought the shares in 2001 and were holding them until now, you made 2,000 times your money. Absolutely amazing, and just an example of how much money you can make if you actually hold the companies till they play out how you think they would play out, right? As long as the thesis plays out, you keep holding it and you make a lot of money. So I'm going to give you a couple of excerpts from the book 100 Baggers. I think this is one of my favorite investing books. I don't have affiliate links or anything like that, but you can look it up on Amazon. It's just called 100 Baggers by Mayer, who is the author. And, I think it's a great book. It's not too long, so you can quite quickly read it. I read it quite often. Let's say it's a great book. And this is where I got the example from Monster Energy from. So a couple quotes, and I think this kind of shows you what this video is about. The biggest hurdle to making 100 times your money in a stock, or even just tripling it, may be the ability to stomach the up and downs and hold on. Yeah, that pretty much reveals what I think is the most important strength that an investor in especially smaller companies has to have. the urge to grab a quick gain or let go of a loser is strong. We're like little kids, right? Like we can't wait, we are impatient, we start to get like weird thoughts, we start to doubt ourselves, we start to doubt the thesis if the stock price starts underperforming for a while. And, once, let's say the stock went up 50%, you want to lock it in to, prove it to someone that, I made 50% this year. Wow. And I'm such a great investor. But, if you just think long-term, that's just not a good way to go about it. And also, letting go of losers. If a company is down like 50, 60%, most people will just cut their losses and think, oh, okay, I got it wrong. But the price of a stock has nothing to do with the fundamental performance. They are, in many regards, like disconnected. The most powerful stock moves tended to be during extended periods of growing earnings accompanied by an expansion of the PE ratio. So as we saw before, it's typically that both things happen at the same time. The periods of PE expansion often coincide with periods of accelerating earnings growth. So, once earnings start growing really quickly, the earnings multiple starts growing really quickly, and you get like a double engine that really pushes these stock prices very quickly, very high, which, seems like almost like insane. But, when a company has, stagnant earnings, you don't give them a high multiple. When a company's earnings are growing fast, you give them a high multiple, and then the earnings go up. And so stock prices can, 10, 20x in less than a year. It's pretty common. Some of the most attractive opportunities occur in beaten down, forgotten stocks, which perhaps after years of losses are returning to profitability. Now, this doesn't maybe apply to Aduro fully, but what applies to Aduro is Aduro has years of losses currently, right? Aduro is not profitable yet. They're burning massive amounts of money for R&D, for research, for engagement with partners. And, the lesson here is really once Aduro becomes cash flow positive, and then once they start to really make lots of profits, the valuation will, I think, reflect that. It will be pretty clear that Aduro is not worth what the current valuation is because it just doesn't make any sense. But if you look at it from, examples from other companies, it just makes total sense. Small companies can grow 10, 20 times and still be small. Yeah, I mean, when companies start out at like $100 million and they grow to $1 billion, in the grand scheme of things of like publicly listed companies, $1 billion company is still not a large company. I mean, most people haven't heard of vast majority of $1 billion companies because they are like very, very niche in their field. The single most important factor is growth in all its dimensions: sales, margin, and valuation. I mean, I agree with that, obviously, right? You have to increase the sales, you have to increase your margins, you have to increase your valuation, depending on how you define valuation, but it just makes a lot of sense. This is the author quoting a different study, but which we agree with. Our analysis of the 100x stocks suggests that their essence lies in the alchemy of 5 elements. Size is small, which I think is the case for Aduro currently. Quality is high for both business and management. I think business here for Aduro is the chemistry, which is, top tier. There's no competition really that even comes close to the chemistry that Aduro has. The, decade plus of experience, of experimenting, of figuring things out. And management, if you saw my previous videos on that topic, I think management's also absolutely top tier for Aduro. So, this combination is just, really, really powerful. Growth in earnings is high. Currently Aduro is not profitable, so this doesn't apply yet. Longevity in both quality and growth. So, Aduro has to maintain the quality in the chemistry and the management, and also has to continuously grow and grow and grow. And I think this will be the case for Aduro, right? Because the sky's the limit. The market is absolutely huge. There's lots of, the path to growth is pretty much unlimited. Obviously not completely unlimited, but you know what I'm saying, right? Like in reality, something, Aduro might just get bought out at like 10 billion or something, which will prevent them from growing further and get maybe get like exclusive with one company or something like that. I don't know, but for the foreseeable future, Aduro has a pretty much unlimited growth runway. And the price is favorable for good returns. I think Aduro's price is very, very favorable, so I think that's also a given. And this secondary study concludes that in the ultimate analysis, it's the management alone, which is the 100x alchemist. I think for Aduro, management is top tier, so I don't think there's really anything to worry about. We're about halfway. If you haven't subscribed already, please do so. I really don't like begging you guys, but it just really helps me out. I don't ask for money currently, so if you want to just support me, it takes you 2 seconds. Just subscribe and let's get back to the video. Thank you guys. So with this in mind, we can look at the section of the video which ties it back into what it means for Aduro. And the question I really want to examine here a little bit closer by looking at a different company and comparing the two is, can Aduro really 100x from the current prices? Might seem a little bit absurd. Aduro is trading, depending on when you watch this video, like around like $350 to $400 million. And as a comparison to a different company, for example, AST Space Mobile, which is also, let's say, started off as a micro cap and grew really quickly. They're trading around 30 billion, again, depending on when you watch. So that's almost 100x of Aduro's valuation. So I'm going to be talking more about AST Space Mobile right now, but it's important for you guys to know that this is not intended to be a criticism of AST Space Mobile. It is not any due diligence replacement for AST Space Mobile investments. Or if you're currently an investor, that doesn't mean I'm bearish on the company or telling you to sell. Again, this is not investment advice. This is just the purpose here is comparing Aduro to Space Mobile and showing you, that you're gonna see. But again, this video is not about this company. This is about Aduro, and you're gonna just stick with me and you see why I'm making the points that I'm making. It might seem like I'm shitting on the company, but I'm not. It's just a comparison, so just stick with it. So in my personal opinion, Aduro has a better starting point in business compared to AST Space Mobile. So AST Space Mobile has, I would argue, limited pricing power. So, for those of you who don't know what the company does, they're pretty much launching satellites into space so that smartphones can connect to the internet anywhere in the world. That's pretty much, what it is. So you have cell coverage. So your phone directly connects to a satellite and has internet everywhere. I would argue they have pretty limited pricing power as, selling capacity, because they're selling capacity to mobile carriers. So, like AT&T, for example, in the US, a big carrier, they sell directly to them their services and not to final customers, right? And for example, like in the US, which is currently their market that they target the most, the rural mobile users have cell service almost 99% of the time. So, if they're focusing on the US, and this is like their big, the big thesis is that they help people be connected to the internet everywhere. Like, how much are people really going to be willing to pay to have internet everywhere, right? So this whole point is like, I think they have pretty limited pricing power, right? Like, you have to really, if you then started expanding into poorer countries where, pricing power is even lower. They can like double their mobile service fees. Like, people will just not put up with that. I also think the company has intense competition from well-capitalized rivals. So, they recently started to get some government contracts, but there's like a lot of competition. Lockheed Martin, L3Harris, Lockheed Rep, Northrop Grumman. And on the private side, of course, SpaceX is a very big competitor with Starlink because they also have direct-to-cell. And, one really, really fun fact, not fun if you are AST Space Mobile investor, is that, SpaceX does not only own Starlink, but also launches the satellites of AST Space Mobile. It's a pretty big risk when your largest competitor can also cut you off at any point, and then you're just completely screwed, right? Obviously, I don't know if they would actually do that, but I think if AST Space Mobile actually became a large enough threat to SpaceX and Starlink, it could be pretty dicey here. So as you see, there's a lot of problems with the company, I think, especially from a long-term perspective. I think there's also substantial execution risk because, as you might imagine, building satellites and launching them is very capital intensive. Satellites are quickly outdated because, technology moves on. You need to always have the best thing available because of the high competition. The satellites have a limited lifespan, so depending on how you look at it, let's say 7 to 10 years approximately. They're expensive to build and to launch. And again, you directly compete with Starlink. And the costs also, if you look at their guidance, the costs seem to be really creeping up. So management is underestimating how much it's going to cost. So execution risk is really here. You need a lot of money. It's very capital intensive, and mistakes get punished by billions spent into nothingness. And I did a little bit of math. Again, this is not like due diligence. I'm not telling you to invest or not to invest. Please do your own due diligence in the company. I'm just using this again as a comparison point with Aduro to just show you the differences between those two companies, right? For AST SpaceMobile, just to maintain the full satellite constellation, so it's pretty much what they plan to have, pretty much worldwide internet access to everyone. They would have to launch tons and tons of satellites. And just to maintain the satellites, so because again they have 7 to 10 year lifespans, they would need annual capex of, depending on which estimates you take, like $400 to $800 million. And this again, assuming current satellite prices are going to, current satellite plus launch prices are going to stay exactly how they are right now, which obviously inflation is a thing. And, especially if you want to put the newest technology in there, it's going to be very expensive. To build an initial constellation so that, they launch all the satellites that they want to launch, it's going to cost them like $3.5 to $5.5 billion. Again, assuming prices don't go up further. So as you see, like this company, they're going to need to either dilute like crazy or take on debt, or it's just very, very capital intensive business, and with high competition, right? Like they're also going to be needing very, very high R&D spending to keep pace with competitors. I think that SpaceX and Starlink, big competitors, which already I would say have a first mover advantage. So that's also a thing that I didn't mention here. When you don't have first mover advantage, you have to really provide a way better product, because you don't have all the network effects, and people already have a service that they can use if they want. And I would also argue the sector that they're in can be quite quickly saturated and oversupplied, which will push down margins. If there's like, that if there's a lot of competition and you just have to build a satellite to launch it, obviously it's not as simple, but yeah. And what I was a little bit shocked by, that their current capex already is $300 million per quarter, right? Which you look at here, they're already overspending what I would guess is their maintenance capex. Obviously, they're probably launching like more satellites than would decay per year, let's say. So, but you're spending over $1 billion just in capex per year. And there's really no profits in sight yet. And I don't know if the company will actually ever be profitable, because the capex is just continuous. And it's just crazy. I mean, just to show you that this company is valued at $30 billion currently. Obviously, I didn't mention like all the revenues and profits, because it's still very tenuous and it's really unclear what their revenues and profits are going to be. So you might be like a little bit confused of why I was diving this deep in this company, even if it was in a completely different sector than Aduro. So why are you doing this? I don't understand. Well, it's actually quite simple, because if even such a company, which had a lot of risk, a lot of problems, a lot of what I would say, like it's really not a super crazy valuable business, from my personal opinion. Even then the company is priced at $30 billion. So if that can happen, why can't Aduro be priced at $30 billion, which would be about 100x? Like, I would personally even argue that Aduro is way superior to this company, right? So as a comparison, like Aduro has very strong pricing power. They have a massive, total addressable market. So around 200 million tons of plastic that Aduro can actually convert, which is like the polyethylene, polypropylene, polystyrene. About 200 million of those are produced every year. And if you assume, I would say like conservative $1,500 per ton, the total addressable market every single year is 300 billion. Aduro also has predictable, stable OPEX. So once they build a commercial plastics recycling plant, the OPEX is known. Their expenses are like, a couple chemicals, energy costs, etc. That's all pretty predictable. Input materials that they have are pretty much worthless to others. So, they use plastic waste, which, they're pretty much going to get for free, or maybe even get paid a little bit to take it, because it's just worthless to anyone else. They have a very strong moat. They started their technology research in 2011. So it's like 15 years that they've been working on a technology. They really worked out like the vast majority of the kinks already. They started with bitumen upgrading and discovered that it actually works with plastic as well. So, the moat is very strong. There are not really any competitors that are be coming up because, again, you will need 15 years or, even if you do it fast, like 5 years to build a competitor. And there's really nothing like that on the horizon that I can see. Again, like I mentioned, I think Aduro's, compared to AST SpaceMobile, Aduro has close to no competition. The two big competing technologies are mechanical recycling, which is very limited feedstock availability because you need a clean stream, and pyrolysis, which has very high costs, low quality product, and in general is definitely an inferior technology to Aduro. I would also argue Aduro is pretty capital light, and Aduro is going to pursue a capital light long-term licensing model. And even if Aduro decides to build them themselves and fund it, commercial plants are quite low capex. So let's call it like 50 million per commercial plant if it's like 25 or even like 40,000 tons per year. But this number is all approximate, but it's not 500 million, it's not 5 billion, it's like a 50 million per commercial plant. The plants are going to have very high ROI, so the investors or whoever gives the funding is going to quite quickly get their money back. They're very modular, so if let's say a smaller player needs a smaller reactor, they don't have to put down like 50 or 100 million. They can just put on like 10, 20, build a smaller plant, and it works. The plants can also be built quite quickly, so let's say take 2 years. I would say for a commercial plant, maybe even faster, like 1.5 years, maybe 2 years, something like that. Especially if we get like, if the companies get pretty experienced at building these plants, you can probably build them in a year. So that's amazing, right? You get the idea, you sign the contracts, you build the plant in a year and a half, and then you right away start making money. Because, the chemistry is the special sauce here. It's not a special type of pipe or, a special type of metal that withstands high pressures or something like that. No, it's the chemistry that's the magic sauce here. So you don't have to spend on expensive equipment. And, that's all very, very positive. I mean, again, compare this slide to what I mentioned about AST SpaceMobile, and you see like how much just, in a better position Aduro is compared to the competition, compared to CapEx, etc. So, I mean, you can make your own conclusions. I'm gonna go back here. Just showing you that Aduro, it's just an example, right? I would argue Aduro is superior to AST SpaceMobile, but still Aduro is trading at 100th of what AST SpaceMobile is trading at. So why can't Aduro trade at 30 billion when their, initial starting conditions are better? And obviously AST SpaceMobile is already getting commercial revenues, but Aduro is not. But once Aduro gets commercial revenues, why can't Aduro be trading at 30 billion, 50 billion? I would personally argue plastic waste is a larger problem than having mobile internet everywhere on the planet, because for the most part that's already a solved problem. I mean, most of us already have internet everywhere we go, so like it's not really clear to me that the market is really that big. Like even in developing countries, there's a lot of mobile internet penetration, and are people in third world countries really gonna pay you like $20 a month? No. I mean, yeah. But Aduro, everyone has plastics packaging, no matter where you are. And again, like no matter where you are, you're gonna make a lot of money if you recycle the plastic, because the product is a globally traded product, right? It doesn't matter where your factory is. If you create an oil product, you can sell it worldwide, right? Like this just makes it an amazing source of revenue, even like for underdeveloped countries, right? Which need tax revenue. They need to clean up their waste to, like, let's say, like to attract even like tourism, for example, right? If you have a dirty landscape filled with plastic, like tourists are really gonna be turned off by that. If you can clean it up and on the side make a lot of money, and drive your export sector, drive jobs, etc. Like from a business model, it just makes way more sense. The addressable market is, in my opinion, way larger, and the company is trading at 1% of AST SpaceMobile, right? So you can see here why I'm like super bullish, and I'm not even like people claiming that Aduro is like worth less than like 10 billion is just like how do you come to this conclusion, right? Like seems to me pretty obvious that once the big investment players with lots of investable capital come in and they really understand what Aduro is about, let's just say I don't think then once that happens, two-digit stock price is going to be a thing. So yeah, that's just my personal opinion. Again, not investment advice and not a promise. So, if you finish the video, just subscribe. I really appreciate it. I appreciate the support, both on YouTube and on X. And yeah, just thank you guys, and see you guys next time.